Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are a multifamily investor, an aspiring one, or an industry insider, or maybe you just love creating passive income and generational wealth, well, you're in good luck because we have a great show for you today. Another Gray Report recap. We're very excited to have on not only Matt Bosnagel, but also Jay Reeder. You've seen Matt on previous episodes. Jay was on an older episode as well. Matt is our director of communications and marketing, and Jay is our vice president and director of acquisitions and asset management here at Gray Capital. A lot of good insights on what is happening this week in multifamily, this week in commercial real estate. A lot of stuff happening in the markets in general. Really excited to get into it. But first, before we do, a quick word from our sponsor. This episode of the Gray Report is sponsored by GrayReport.com, the new and premier multifamily intelligence aggregator delivering the most recent research reports, market data, articles, insights on the multifamily industry, real estate, and the economy, updated 24/7. If you like the information that you're getting out of this video, this recording, and the Gray Report newsletter itself, well, GrayReport.com is just that next logical step to stay more up to date. But instead of having to wait once a week to kind of get all the information put all in one spot, whether that's in the newsletter or in these recordings, now you can hop on over to GrayReport.com and get that information 24/7. Again, that's www.GrayReport.com. All right, without further ado, let's bring Jay Reeder and Matt Bosnagel into the conversation. Matt, Jay, how are you guys doing today?
Doing great, thanks.
I'm well, Spencer.
Awesome, guys. Well, it's been an exciting week. It's been an exciting couple of weeks for us. We've been pursuing opportunities, got us a couple things in the hopper, getting close, but we got all kinds of crazy stuff going on in the market, in commercial real estate, and the economy in general. So let's just jump right into what is in this latest edition of the Gray Report newsletter. It came out Thursday, May 20th at 8:30 this morning. Matt, post-pandemic market coming into view. What does that mean? What is coming into view?
Yeah, the story this week is that there's a lot of money out there. People are spending it. And when people spend more money, a lot of times prices go up. So of course, people are talking about inflation in general and inflated prices for specific commercial real estate properties. But investors in these markets are beginning to look past the current froth in the market to actively pursue opportunities and understand the long-term potential of an investment past the immediate environment and whatever seller's market it might look like. I think the term new normal is an overused cliche, mostly because the old normal never really lasts that long to begin with. But it does seem like investors and industry leaders are not throwing their hands up in desperation. They're gathering information, taking calculated action. So maybe a few months ago, a buyer would see a multifamily listing and be turned off by the higher price. Now they're taking a second look maybe, and they have more information and experience in this new market environment, and they could really figure out a strategy that may make sense for an investment. What's going to be interesting in the next few months is how this increased activity and price discovery in the CRE markets will factor into the many different inflation and pressures in the economy.
Good,
So,
very awesome. Yeah,
things are warming up.
And I think that that's really been the story kind of throughout 2021. A lot of capital chasing, not very many opportunities. Jay, what are you seeing in the market? Do you see things kind of opening up? Do you see any kind of concern out there from buyers, from sellers? What are you seeing in the market? You're director of acquisitions. You see this stuff every day. You're talking with brokers and lenders on a daily basis.
I think the biggest thing is kind of the general understanding of getting back to business as usual. In the last year, people are still buying and selling apartments, but it was done a little bit differently. There were some more remote stuff being done that took a lot of kind of technology resources, whether it was virtual tours and stuff like that, which was things that had been used in our industry, but maybe kind of were on the periphery, where last year they kind of came front and center. And now those resources are still there, but people are wanting to do in-person tours again. And the idea of coming and seeing the assets in person and doing a lot of that kind of research on the front end is really starting to pick up. And then like we said, with prices rising, we've had a number of deals that we've gone after this year that it is true that there is a lot of money going after a few assets. I know I had some conversations with brokers in the last few weeks. A lot of them are saying they're getting at least 5% over their BOV and whisper prices on the LOIs and the signed PSAs. And so it is without question showing that there is inflation even within maybe just this asset class. But I think the inflation in this asset class obviously trickles down to rents. And then, as Matt said, rents kind of trickle down to what people are spending on other money. And so there are definitely things moving in the market, but it is really eye opening to see all the pressures from last year kind of coming to a head this year, but then that kind of coinciding with everything starting to open back up, you start to see information and people flowing similar to what they were pre-pandemic, but you're seeing a lot of the pent-up demand on the capital side really kind of pushing things in ways we hadn't seen previously.
Yep. No, I think that makes a lot of sense. A lot of buyers, a lot of pent up demand for sure. All right, let's get right into the snapshot of rates and markets. The 10-year Treasury is clocking in at 1.64%. That number will probably sound somewhat familiar to you because it's basically unchanged from the last edition of the report. You can see in this chart, really we have had a lot, we've essentially plateaued at the 10-year Treasury. And, it's why we report the 10-year Treasury, why it's an important metric. It's an important metric for, commercial real estate. It's an important metric, for the economy in general. It's what so much debt is linked to or indexed to. It's also an indication of where inflation is going, and it's looking out 10 years to see kind of what kind of return is going to kind of break even on your money. And so it's a crucial macroeconomic indicator. That's why we track it, one, to kind of see what the macroeconomic landscape is like, but also it gives us an indication of potential yields and really kind of the yield spread between, where interest rates are and where cap rates are. And, if that 10-year Treasury yield declines, that can widen up the spread theoretically. And theoretically, cap rates will track loosely, but they will still be in some kind of relation to the 10-year Treasury as it goes up and down. Not exactly correlated, but there definitely is a bit of correlation between the U.S. 10-year Treasury bond and cap rates for commercial real estate in general. So let's go back and look at some other snapshots, other market rates. We have the 30-day LIBOR kind of popped up just a little bit, now back at that 0.1%, but again, basically unchanged. And again, this is a shorter term rate that a lot of variable rate loans are indexed to. Usually there's a spread over that LIBOR rate. And the same thing with SOFR. If you take out your loan for an acquisition, if it's a floating rate, oftentimes it's going to be whatever SOFR is plus a certain amount of basis points or a percentage. It might be 250 basis points plus SOFR or LIBOR, which again, that plus SOFR is basically nothing. So you're basically just paying whatever the spread is. HUD 10-year Treasury minus the 2-year spread. This is the difference between the long maturity bonds and short maturity bonds. It's coming at 1.52. Not very much change there. HUD 223F. Again, these are long-term 35-year term, 35-year amortization, stabilized multifamily acquisition loans. Interest rates clocking in right around 2.5%. But on the HUD 221D4, again, that's a rate for ground up development, a 40-year term, 40-year amortization. You're going to have to pay a 3.25% for that very long maturity loan. Fannie and Freddie, they're hovering above 3. And again, as a reminder, it depends on what kind of term for your agency product. Whether it's interest only, if it's going to be floating, it's going to be fixed. There's a lot of variability. Jay, I think we just got a quote yesterday. Was it for a Freddie 10-year floating rate? I think somewhere around 250 basis points over LIBOR plus or minus.
Plus or minus, I think a quoted rate was 2.65.
Okay, but that's all in, right?
That's all in.
Yep. Okay. And was that based on LIBOR or SOFR? Are they still
SOFR.
using? It is SOFR. Okay.
Yep.
Yeah, LIBOR has been it's been being phased out. It's been controversial. The last loan that we did was based on SOFR, not LIBOR, and I imagine more loans in the future will also be indexed to SOFR. The NAR REIT, Equity Apartments REIT, that is, a little bit unchanged. The apartment REITs and real estate in general have been doing quite well as of recent. Gold has been improving, clocking in at $1,866 an ounce. But steel and lumber and commodities in general have come, besides gold, have come down quite a bit. Because obviously lumber, we've seen an incredible amount of run up. We've talked about it every single episode of the Gray Report. But let's just look at the chart. This is going back for the last year or so. An incredible run up last year, the decline, and then another incredible run up so far in 2021. These are for the random length lumber futures continuous contract. We kind of peaked here at this almost 1700 mark. Now we're down at, I guess we clocked up here. We printed this. I think these are daily candlesticks at 1387. So we've come down. This looks to me like a pretty classic, mean reversion. This is basically kind of halfway up this run, which we had some resistance right here back in mid-April. And we're kind of back to that point. But man, lumber couldn't, again, this looks like more of a cryptocurrency chart, not a lumber chart. So pretty incredible. All right. And now for a couple other things of note. Crude is still moving $63 an ounce or a barrel. But Bitcoin and Ethereum, crypto, absolute bloodbath in the crypto markets the past several days. A lot of, what crypto traders and enthusiasts call FUD, fear, uncertainty, and doubt. The combination of Elon Musk, kind of questioning Bitcoin, saying that Ethereum's not, or Tesla's no longer going to accept Bitcoin. China saying that they only want to use their own digital currency. Concerns about the environment. I'm just curious. Is this all real, or is this an opportunity for the major institutions who missed out on Bitcoin over the past several months in the last year, using their influence in the media to bring the price down to get in at a better basis?
Well, Spencer, no matter what the reason was, I have a big question. Something seemed to, and I was looking at the chart. Something happened with the Ethereum and the Bitcoin price at 9:14 a.m. yesterday, and
Mm-hmm.
and I don't know if that was when someone made a tweet or if that's a natural. It's 16 minutes before the market opens or something. But at 9:14 is when both Ethereum and Bitcoin crashed. And it's interesting that both of them that this happened at the exact same time. I
Well,
don't
yeah,
know. I don't.
they
Yeah, I
are.
can't explain it. But
The two are. Highly correlated. A lot of the crypto spaces, a lot of the tokens and coins kind of trade together, and I'm not exactly sure what happened right at that point, because I saw that also. It kind of dipped down for just like a couple minutes. This is the Bitcoin US dollar 2-hour chart from the BitBay exchange. I think it bottomed out right here, at $30,000. We're back at 42,000. Yeah, it's a good question. I'm not exactly sure, what happened. It is interesting. Basically hit this 30,000, on the dot, and has immediately bounced back off of that level. So we've got, pretty strong resistance. To me, I've been invested in crypto, since 2013 or 2014. That we almost had we had a 50% decline over the past couple of days. But if you've been involved in the kind of the cryptocurrency space for more than a couple of years, this is kind of par for the course. It's really not like it's really not too surprising. And this other cycle of people, calling for the the end of cryptocurrencies for one reason or the other, we've heard this too many times before. That's why, again, it's total conspiracy theory, but a lot of institutions have been playing catch up and have been missed out on this run over the past year. And is this more of a move to accumulate at a lower basis. And, it just takes, Elon Musk saying a couple things and a couple articles about China, and then some fake articles, you saying that
Hmm.
Tesla had sold their Bitcoin, which wasn't the case. Elon Musk confirmed a couple days ago that Tesla was holding the rest of their Bitcoin holdings. They weren't selling. So a lot of misinformation. And it creates incredible opportunity because you can get a 50% gain then.
Yeah.
So I don't know. And then S&P 500 still doing pretty well over the 4,000 mark. So good for you, S&P 500. Okay, let's get into the Gray Report newsletter, the meat and potatoes. Now we've talked about other markets, but I guess before we do, I think it's important to mention why we talk about all this other stuff, why we're talking about the S&P 500, why we're talking about cryptocurrencies and commodities, because this channel, what we do is centered around multifamily, but it comes back to as a team right now, Great Capital, we're rereading, or I'm rereading Robert Kiyosaki's Rich Dad, Poor Dad, and he speaks a lot about financial intelligence, and you're building your financial knowledge, and the more that you understand about the financial system and how money works, how it doesn't work, how money is created, and how it's destroyed, and how debt's created and destroyed, it gives you so much more insight into what the full landscape looks like, and how everything is correlated to some degree and affects the others. I mean, in multifamily, it's a very microeconomic. I mean, it's location, very granular operations. We're looking at exactly where we are in the street, but at the same time, there are city, state, and national trends that do affect the apartment industry and renters, and in migration, and these larger trends that affect our business plans and strategies. And you have to be aware of both. I mean, you can have the right business plan and execution strategy, but in the wrong market at the wrong time, and vice versa. You can have the kind of the wrong plan, but if you kind of are in the right market at the right time, well, you can kind of screw up and still kind of get ahead. And so if you can understand kind of the micro and granular at the same time, the macro and kind of the meta trends, you're going to be rowing in the right direction and going to just be operating at all cylinders. So do you guys have, I guess, how do you guys kind of look at some of these other metrics? Whether that's commodities, stock market, different indexes, cryptocurrencies. What do you guys see, and how does that relate to the multifamily market for you?
Obviously, the biggest one for me is understanding debt and understanding kind of where those rates are, because like you said, those as well as cap rates truly follow each other, because people need to expect certain returns on their investments. So that if rates are rising, it's going to be really, really hard for um, cap rates to keep going down, because there needs to be some sort of delta there. Otherwise, we turn real estate into a commodity that you're holding for its future value as opposed to its current ownership value and its cash on cash return of what a lot of people get into real estate for right now, is kind of that near sight and far sight. And so understanding where kind of those operations are allows us to look at the market and say, what are good opportunities? And then from there, it says, as you watch it over time, you can see what the effect of all of the different industries have on, whether it be interest rates, whether it be apartments. I mean, the one last year that we talked about the most was, we've seen a huge run up in lumber this year, but we started to see that last year. And we really saw kind of that replacement cost on construction be something that we really looked at when we were looking at acquisitions, as opposed to just the numbers on the paper for the return. And so looking at how all of those kind of coincide with each other and allow us to make decisions about the current and future value of our investments really kind of lets us keep our eye on the ball.
Yeah, I think that's a good point, especially in the lumber and looking at that future replacement cost. I think that's a good point. Okay, well, let's kind of get in again to the kind of the first piece on the newsletter itself. And then, you can find all this at grayreport.com. So if you missed the newsletter, hop on over to grayreport.com. You can find all these articles there. Matt, so post-pandemic trends, special report. I want to bring you in. Marcus and Milichat put out a really nice report kind of going over different asset classes in commercial real estate. What were some of your takeaways, and point out a couple of things we should focus on the report?
Yeah, this report kind of covers a lot of the things I described earlier. Cap rates are compressing, but investors are still investing in commercial real estate. And I think that Marcus and Millichap frames these conditions as, and I tend to agree here, as a recovery more than a period of irrational exuberance. It's not like people are clamoring as much as they're kind of adjusting their frame of mind and really getting used to the idea that prices are going to go up, and this may be a long-term thing rather than just a froth in the market.
Yeah. Well, I think that's a good point, and I think it's all everyone's kind of like readjusting and resetting, and I think this cap rate margin is still compelling, showing the difference between the 10-year and just the average cap rate. I think this is across all asset classes in commercial real estate, but we're running at if there's a 460 basis point spread, that's more than the spread there was between 2014 and 2018. And so if you're looking at cash flow, and the difference between, for stabilized properties, between your cap rate and the 10-year treasury, while prices seem incredibly, high, it's all relative to, that cost of capital. So I think that those are all good points. So I would check out, if you're any asset class, commercial real estate, check out this Marcus and Millichap report. Again, you'll be able to find it at grayreport.com. Going over industrial, industrial's been a great performer throughout the pandemic, just the boom in e-commerce, that last mile delivery, and multifamily also, again, Matt, as you said, and again, it comes back to this question of, how much it is inflationary, how much is reflationary, or really just kind of gaining back the traction from the losses of last year.
Yeah, and to kind of echo what Jay was saying, what you were saying about the numbers in general, about the economy, it's also important, if you're in one sector of real estate, to really look at all of the different sectors, and because they're all interrelated. There are things that could happen in the industrial market that could have a knock-on effect in multifamily. I think that the story of retail and hospitality is an important story that will affect multifamily, specifically, what locations people are going to, and the kind of environments that people are getting used to. I don't think that it would. I think it's always important to have a step back and look at the commercial real estate just in general, and how and what kind of stories and what kind of trends are happening in each sector.
Yeah. Yeah. No, I think that's a good point. It's, and again, I'm just looking at industrial, and I was going back to retail. Yeah, it's all pretty interesting. And you're right, they all do interrelate. And then, again, in terms of kind of macro, where is like the big money flowing? Some people stay in
Yeah.
commercial real estate, but they might jump around and favor one asset class over the other, depending on what's in favor. Industrial and multifamily have been very popular. Cap rates across the board have come down, but industrial used to be able to get some nice elevated cap rates, maybe 100, 200 basis points more than multifamily, but now they've come down and they're kind of closer to the multifamily cap rate range. And so are people going to continue to flock to industrial and have some people come over to multifamily, because they see a similar cap rate at
Well,
this
yeah,
point.
it's like the services versus discrete products story is something that I'm just think it's interesting, because it was such a big transition during the economy. People, things versus experiences, however that pans out. But that's something that I'm definitely watching.
Yeah. Absolutely. Okay, so next on the report, Biden administration's tax proposal. Cushman and Wakefield released this report, and a lot of the brokerage houses, I feel like, are kind of trying to make their predictions right now, because there are a lot of buyers and sellers who are mostly the sellers, who are really trying to concerned. They're trying to figure out, should I sell? Should I not sell? Are capital gains going to go retroactive? Is 1031 going away? We've had some personal experience with this, trying to get some off-market deals, and so just not sure what to do. Jay, I think you had some insightful thoughts, and when we were discussing this earlier today, can you kind of give us like a rundown? Capital gains. What's Cushman and Wakefield thinking that's going to happen? There's a lot of proposals out there, but as we all know, what's kind of proposed in Congress isn't always what ends up happening. So, what are your thoughts? What is this report kind of breaking it down?
Well, the big thing that this this report kind of highlights, first of all, capital gains. Second thing that they kind of look at is 1031 exchange. And then one of the other things they kind of highlight is the adjustment of corporate tax rate. When I was on last time, Biden had just made his speech and we kind of discussed where we thought this might end up. And at the time, I remember saying, hey, like everyone's thinking it's going to go to 39. Everyone knows these are up for negotiations. I wouldn't be surprised if it ends up closer to 30. As we can see here from Cushman Wakefield, it looks like they agree. They're kind of pegging it that they think it's going to end up kind of in the 28% range. As they kind of say, there is a contingency, even though this is something that the Democratic Party has brought kind of to the table. There are kind of factions within the Democratic Party that benefit from some aspects of the capital gains. And one of the other ones that's along with this as well is kind of the idea of carried interest in these. And so those are things that are not going to be able to just kind of get run through, check marked, and they're going to be as presented now. So those are ones, as Spencer's showing right here, the carried interest. These are things that they don't even think that anything's going to happen to carried interest because, again, there's enough people on both sides, Republican and Democrat, that benefit from this and have constituents and have investors, not investors, but fundraisers for them that benefit from kind of these tax advantages. And so because of that, it's going to be very unlikely that these things changes.
Yeah.
The one that is very likely to change is the 1031 exchange. This has been kind of a hot button issue, and it's been the one that's always brought up. However, if you read this report, it gives some really good insight that it seems like it's a very kind of large thing that's going to absolutely destroy the real estate industry, but there's actually not as many 1031 exchanges as you would think if you were just kind of talk in general. And so it's going to be a relatively frictionless kind of piece to get through relative to the other things they're trying to pass in this bill. And so this is kind of the one everyone can get behind and say, hey, this can go away. They're going to restructure this.
I see. I guess I'm gonna take the opposite, and then maybe not the opposite, but I disagree that I think this is gonna definitely go away. I mean, I think it's possible, but I'm not convinced that they're actually gonna get rid of this. There's too many people. There are too many Democrats that use 1031 exchanges. I think it's a good point to your point.
And I don't think it may go.
Yeah, I think to your point, it only makes up, what, 6 to 7%, maybe 8% of total sales volume. So it's not like it's all the entire market is, made up of 1031 exchanges, but it's not totally insignificant. But again, it's one of those things, sorry, go ahead, Jay.
I was saying, I should preface, I don't think it's going to go away, but I do think that cap is going to happen, and the cap might get bumped up to $1 million, but I don't think we're going to see some of the large 1031s, especially kind of in the multifamily space that we see of investors kind of liquidating and having a $5-10 million slug to go reinvest.
Yeah.
And it's cheaper for them to take a lower return than it is to pay the tax burden. I think those are going to start going away. I think the 1031 is going to happen. I think it's really going to be pretty dominant in your single family home investors and kind of your smallplex 2-4 level. I think that's where this is really going to thrive, and it may continue to exist, because I think if you get rid of it, I think it's going to be really hard to find an investor base for kind of those mid-size units.
Yeah, that's a good point. And it kind of comes to me, I guess it comes back to, what's the point of what's the point of raising these taxes? Is it to raise revenue, or is it to really kind of more redistribute wealth, or kind of really incentivize or de-incentivize certain types of action? Because we're not raising a lot of revenue, and this is the point that Cushman and Wakefield makes. I mean, on carried interest, they're going to be bringing in $14 billion over a 10-year period. It's like $1 billion a year, and $1 billion is a lot of money. But it's like the smallest drop in the bucket. It really doesn't move. It doesn't even remotely move the needle. And the 1031 exchange, I mean, it's a little bit more, potentially could generate $40 billion. but that's also, there's money that's not in potentially going to be invested. And $40 billion, that's $4 billion over $4 billion each year over 10 years. That's really not, it doesn't really move the needle. I guess every little bit counts, but again, it always begs the question on all of this is what is the point? Is it more of a political move, or is it actually trying to be fiscally responsible? So now, Matt, we've got, according to Business Insider, it looks like rebounding rent prices could be the thing that makes stronger inflation permanent. We were having a good conversation kind of before we started this. It's kind of chicken and the egg. Is that asset prices push rent prices, and rent prices put asset prices. Is it both? All the other then it's all the other prices that are rising, or whatever's going on with inflation, the broader economy. Bring us up to speed. What's Business Insider's take? What does Ben Wink have to? Is that how you pronounce his name? Wink?
Well, let me look at it here.
It doesn't
Yeah,
matter.
I would say
Ben,
Wink.
WINCK. What does Ben have to say about this?
So Mr. Wink says that rent's big comeback could mean the thing that makes stronger inflation permanent. I think that it is worth noting that he phrases it as a comeback rather than a spike or a surge, and I think that connotes a little bit more inevitability. And it's just one more factor into what's frankly an overdetermined inflation environment. You have all of these commodities. Now, I know that lumber has stabilized slightly, but there still remains a lot of supply pressures, and a lot of these things are pushing rents up. Wages haven't come up significantly. That may be the final piece, and that may just be the last thing that happens and determines inflation for good. But I think these small things are important and worth noticing. I just listened to a discussion on inflation yesterday, and it talked about, well, this is different because it's really just a lot of little different things. These are all one of a kind lumber shortage, or a one of a kind chip shortage, or one of a kind, but I think that's just the story of inflation. Inflation just happens, gradually, and it doesn't all come out, and it's not like you can predict it either. But it's just this critical mass of these different stories, of these different pressures happening, and then all of a sudden you get that general inflation attitude, and things start building on each other. So I don't think that it's worth discounting these run-ups in prices, these individual stories of pricing pressures, because it does contribute, and it may not be the big push, but it certainly does feel like something bigger is happening than just a collection of small stories.
Yeah, I agree. I mean, it does seem like almost like a death from a thousand cuts in a sense, where it's hard to point to just one thing and say, okay, this is inflation, and all these other things aren't. It's a lot of different things going on at the same time. I think again, it begs the bigger question that has been the big debate. Again, is it going to be persistent, or is it going to be more transitory? To me, it seems like we're kind of on like the roller coaster going up, and we're going to maybe plateau. Yeah. It's more of like kind of a big fast gap up, and then maybe things will stabilize, because Kathy Wood was of ARK Investments, she was making the rounds recently, basically saying we're still in a major deflationary environment. The fact that the 10-year Treasury, like we mentioned, hasn't broken out past the 1.74 range, it hasn't gotten off out of the the 1 3/4. That's a sign that we're still in a very deflationary environment, and we're going to kind of gap up and really make up from all the deflation that we've seen the last 10 years. But it's going to be a quick move, and then are we going to be more stabilized? And if inflation isn't running maybe as hotter in the long term, does that mean the Fed can keep rates lower for even longer, really trying to push as high of an employment rate as possible? We'll see. Jay, what are your thoughts? I'm curious. We're talking about basically this combination of rents driving asset prices, prices driving rents, and how kind of shelter in general drives inflation. As we've seen shelter outpace inflation over the past decade. Is the rest of prices catching up to shelter? But does that give shelter more room to run, or What are your thoughts?
I think it gives some more room to run. I think the idea of rents just kind of exponentially pushing up values is a little bit outblown, just from the standpoint of, if we're going to drive up rents to keep up with inflation, we're going to have to drive up the price of operating these properties as well. And
Yeah.
so it's not like, hey, we're going to get 5% rent growth and we're only going to see 1% expense growth. Now, typically, like I know with our metrics, we try to look for deals that kind of have at least a 2-to-1 income expense ratio. So that way, regardless if maybe you have the same income and same expense load, your weighted average will kind of push your incomes a little bit more. But like we're saying, we've talked about materials, we've talked about a lot of other things. I mean, even just supply chain issues, all of a sudden getting these parts and even laborers to come and work, like, it's not like you could hire them for X amount of dollars and it's like X times 0.02. It's X times maybe 0.07 because they can get a better offer somewhere else.
Yeah, I agree.
Looks
So-
like the economy is revving up.
Wasn't that just perfect timing?
Yeah, perfect timing. Yeah, if you guys couldn't hear that. Yeah, somebody was revving their Harley outside of the office. I know. I think it's a good point. I think it's a good segue to this next piece on, and I think this is kind of obvious what's going on. But inflation concerns are leading investors to commercial real estate. Again, we've even seen in the broader public markets, we've seen real estate and the economy kind of being the leaders over the past really few weeks. The stock market, public markets are a good future indicator of market sentiment. Doesn't mean that's going to happen, but it could be a prediction of the future. And people are seeing some sort of inflation, and they're allocating themselves to assets that track or outpace inflation. So there's no real surprise there.
Now,
But yeah, go
Spencer,
ahead, Matt.
you were discussing this earlier, maybe it was a few days ago, about the cycle between kind of value investing and growth investing, and I'd love to know how this fits into that.
Yeah.
Particularly,
No, I think that's a good point, and I think it's kind of it's that same exact story. Just where a lot of those kind of value stocks or companies that are more just kind of tracked to values and fundamentals, just they perform better in an inflationary environment where technology, it's all about the growth, and they don't really care about inflation. They're much more deflationary forces. They do better at low interest rate environments, and again, just higher interest rates, higher inflation. Whether that is industrials, just more thinking of kind of the old economy. So we're talking about real estate, industrials, commodities, real estate, and they perform better in an inflationary environment. And so you can kind of lump real estate into that entire category. So
I think one thing about that article for me, this is going to be an extreme example, but I know one thing that we see, especially I'm pretty focused on when it comes to the acquisition side, is when I look to buy something, I'm not just looking to buy like, hey, I just want to buy something that I can get 7% cash on cash return. I'm not just looking at buying something that's going to give 15, 16% IRR over a 10-year period of time. I'm looking for something that kind of balances both. Real estate is kind of that good hedge of the here and now as well as the future value. If we start to see real estate truly as that hedge against inflation, Spencer, you and I have had this conversation all the time about cryptocurrency. Like, does real estate start being treated as not just a hedge against inflation, but kind of like a standard where people stop caring about the here and now, the 7, 6, 8% cash on cash returns, but it's that store of value for the future. Now, the difference between like a gold and a cryptocurrency that no one gets returns on now, they get the future value of it, is pretty liquid. Real estate is not that liquid. So it's not like, oh yeah, it's a store of value. If I need the money, I can go get it. But in the same token, seeing that way with the constant compression of interest rates or cap rates, you're getting to that point where that here and now return is really minimized. And what you're seeing is that exponential growth on the future stored value of it. Yeah. And I think that's kind of where you were getting to when I kind of came halfway in on the last article, but really trying to make sure that as we are doing our investment philosophy, we try to balance those and seeing if that's where the market continues to go or if it kind of resets and there's different investment focus when people look at real estate.
Yeah, no, I think that that's all a good point, and I think that was a pretty good summary of why it's so attractive is because you've got the growth potential, you do have the cash flow, and it's interesting. Like last year during the pandemic, and this goes more of the the aspect of really being a good way to preserve your principal, but also when the illiquid nature of real estate can be an advantage of where kind of last year, like the whole market basically took a pause and he said we're just going to wait and kind of see instead of having kind of real time valuations like we've talked about. You can do a paper valuation of at any point, but it's not really real until you actually realize through a sale or refinance or something like that. But like sure, you could have probably taken a moment back in March or April, and theoretically prices could have dropped just because there weren't that many buyers out there, but no one wanted to sell, and that's really the where that strength and that store of value is, because there's the perception of I believe that there's a lot of value here, and I'm not going to let it go for a penny less than I believe that it's worth. And we just kind of everybody took a pause. I mean, we were still buying. I mean, I guess we were still buying things, but then most of the market took a pause, and prices stayed flat until everyone looked around and said, "Okay, floor is not falling. Let's get back in." And then that's when prices have just shot back up. But I think those are all very, very good points. So let's talk a little bit kind of on that topic. What is the concern? Is there's a lot of concerns of a lot of distressed assets. Bisnow had an interesting article. Distressed commercial real estate debt doubles. That's scary, but still isn't the tsunami feared last year. I think that's good. I think that's a good way to sum it up. Like there are more defaults, but it's not, again, the floor isn't falling out, because what did it double? Well, it doubled from 0.41 to 0.86.
Watch your base rates.
Exactly. It's that base effect. Very good point. And again, this is not just multifamily. This is hotels. This is retail. This is office. This is industrial. And so, with hotels, and office and a little bit of retail, having the most issues still, only a 0.86% delinquency rate. That's really not that bad.
Yeah.
Yeah. So
I think that it's another sign that investors and the market is kind of coming back to normal, that people aren't really panicking. They're not seeing this and rushing for the exits or clamoring or anything. They're really, again, like I said, they're making calculated decisions. And also it's worth noting that the pandemic really isn't over. There is still some problems in retail and hospitality. Even though they're coming up, it's not like they're gonna come out of this unscathed. And so
yeah.
I think that there's still going to be some loss there. And I think that's what even, there's another report or another article down below that says the same thing. People are still talking about the pandemic. They're beginning to think about after it, but I think it's a great sign that their eyes are not off the ball, that they're considering these things as well.
Yeah. It's people can now like envision what it's going to look like. Whereas like last year it was, who knows, maybe never, the new, what is the new normal. And it just, we live how we live. I don't know. So, all right, the next piece that we wanted to touch on quick is the dollar slides to a 2.5-month low as Fed rate hike fears subside. In a sense, this is kind of like it's going both ways. On one hand, the value of the dollar is decreasing, so that would be a sign of inflation. A lot of people are concerned that the Fed is going to start tapering and raising that Fed funds rate. But we're not at full employment. And if the 10-year Treasury is not going to go on crazy, I think the Fed thinks that they may have some more room to keep rates low and continuing to purchase assets. What do you guys think?
I mean,
Sorry.
I think it kind of goes, we've seen this not just now, but we've seen this probably for the last 5 or 6 years. I remember when the first time we were below 2 on the 10-year Treasury, and I remember listening to a speaker say, like joke, like, I don't know what's going to happen next. We hit 2 on the 10-year treasury or some other obscure event happening. And 2 weeks later, we went above 2 because all of a sudden they started raising rents. Now, 4 years later, we dropped back below 2. And so I feel like we're in a pretty stable environment when it comes to the 10-year. As much as it fluctuates up and down, obviously the pandemic itself did a number on just every industry. But the 10-year itself has stayed relatively stable the last, outside of major events, the last 5-6 years. And we're not seeing it jump up to 7. We're not seeing crazy rates that we saw way back when. I know, obviously, Spencer, you and I are younger in this industry, but we've talked to a lot of people who were around in the 80s and saw the like +10 interest rates. I know at the previous shop that I worked for, I saw a number of old mortgage rates that were over 7. And it was one of those crazy things where it's like, well, why wouldn't you just refinance? Well, they were Freddie Mac deals, and so the defeasance on them, because interest rates had dropped so much, were just unreal. And so we are not in anything where we see it being 5, 6, 7% interest rates. I mean, the difference in the 2.5 to kind of 4 that we're seeing is, I would call, relatively stable in the grand scheme of history of how interest rates have moved.
Yeah, I think that's a good point. And just as to illustrate, this chart only goes back to 1981, but yeah, that's a pretty long trend downward from when the 10-year was at 15% back in August of 1981. But this is quite the trend line down. And so, and again, this is the big question of, can rates go up in the short term? Absolutely. I think that we can absolutely have some significant transitory inflationary effects. I think that there's so many deflationary pressures, whether that's demographic or technological, that are going to kind of keep inflation at bay in the long term. But again, I don't think anybody can call and say, okay, this is a 40-year time period essentially, but rates have been basically on the interest rates in general have been declining for over 300 years. And so, like, if you think that you've timed the spot in the last 300 years, like, okay, the trend's reversing now, like,
finally,
that's tough. And again, it's all a cycle. It goes down, it goes up, down and up. Again, it's general macroeconomic. It's the business cycle. And this is what you would see as the economic recovers. We had a recession, rates declined to stimulate the economy, and the economy is starting to accelerate, and so rates went back up. But so that's really what we would expect, and really it's not unreasonable to have rates to come back up to even test this this 3% mark. I don't know if it'll go much higher than that. I can see us easily getting at the 2 to 2.5%. I don't think that's unreasonable in this type of growth. It is probably, potentially even healthy. It may make harder to do deals, but again, where rent's going to go, where cap rate's going to go. So we shall see. All right, let's get into a little bit more multifamily, a little bit more granular. We're talking about Indianapolis. Again, that's where our Gray Capital's headquarters is. We have a lot of projects in Indy. We've got a deal potentially coming up in Indianapolis. Can't really talk about it. It's secret. Didn't even hear us mention it. But so let's just quickly, what's going on in the first quarter of Indianapolis? Occupancy rate has bumped up 40 basis points since the last year to 94.8%. That's like what we like to see. Really the long-term average of Indianapolis is closer to 92%. So, being at 95 is always good. Effective rent up almost 4% since last year. Depending on which metrics you look at. I've seen this number at 4. I've seen it at 4.5. Just about every operator I've spoken to, property manager, seems like everybody's raising rents 5% on renewals. So do not be surprised if you see 5 to 7% rent growth in Indianapolis over 2021. Average rent, effective rent, $965. Man, it was at $850. It was at $850. Seems like a year ago. The rent payment tracker looks like, we're down a little bit year over year, 91% collected. That's way below kind of what we're seeing on our deals, but we'll see how things continue. And again, we're just seeing rising rents, better occupancy. We've only delivered about 500 units year to date. Net absorption, it's down right now. That's not necessarily a good sign. A lot of new construction delivered downtown. I imagine there's a lot of slack. A lot of this is the downtown slack. We're seeing a lot of those properties, slow to be absorbed. But this is all good to see. We got a 100 basis point unemployment change, and we were super low, 2.9% in 2020. We're down to 3.9% unemployment rate. That's still pretty good. I mean, that's still kind of a pre-pandemic level. I mean, I think we're basically going back to 2018 unemployment rates or 2017 at 3.9%. So that's pretty good. And unemployment, this was year over year, but we're creeping back to being essentially unchanged in Indianapolis. All right. Any guys any comments on Indianapolis? Obviously, we're fans of the market. What do you guys think?
I think it's solid. I think it is worth the reason why I included that alongside other markets was to really show people kind of show the strengths of Indianapolis and how other markets may be getting a lot of attention, but you can really see the fundamentals of Indianapolis when you compare it to other markets.
Yeah,
for sure.
No, that's a good point. So go ahead, Jay.
And I think one thing to note with Indianapolis too, obviously, this is going to be same true with any large metro that you're talking about. But obviously, Indianapolis has its very distinct sectors. Obviously, the most glaring ones I would say are I would call it the donut. You have your downtown central business district, which Spencer said has had a lot of new deliveries, I would say, in the last 5 to 10 years. Some very, very nice properties, but it's definitely kind of catching a reinvigoration of downtown. Some of those have kind of done a little bit better than others. I think the true absorption will happen over time, but it's kind of the same with any development boom. You're just going to see a year or two of slack before those fully stabilize. Then in Indianapolis, there is that donut that's kind of around downtown, kind of I would almost say as you get out to 465. Obviously, depending on where you are in the town, maybe there's a little bit more on the inside of the loop that there's just not much in there. And if you are doing it, it's going to be a lot of smaller deals. It's going to be some more affordable deals. And it's just kind of how Indianapolis is set up, that we have that kind of no man's land donut before you get kind of to the outskirts of town. You've got the north side, which is growing leaps and bounds. You've got the south side that's doing fantastic. The west side with the airport, with Plainfield, doing a ton of growth with the industrial areas out there. You've got Brownsburg and Avon, which are kind of the up and coming suburbs out there. So we've seen a lot of kind of growth in those. So when we look at Indianapolis as a metro, some of the things that are really kind of pulling the Indianapolis metro is what we're seeing in kind of those growth markets on the outside and the development there.
Yeah.
But
a
then
lot of the
that's
suburbs.
what that's also then doing though is people that may be getting priced out of those suburbs are then coming back in and reinvigorating inside the loop and kind of taking some of those more workforce housing level, established 20, 30, 40-year-old apartments and kind of bringing those up, because with the amount of land that's been developed in Indianapolis, it's hard without doing demolition to develop something new in Indianapolis proper, whereas the suburbs, they're just throwing up on a vacant lot and developing out there. And so it's hard to replace the product that's here in Indianapolis. And so I think a lot of that kind of workforce housing, B and C, has really risen because everything that's happened in the suburbs has really kind of pulled it up.
Yep. And I think that's a great transition to talk about this next article. Peter Linneman, Economist View, Why Cities Will Rise Again. And, again, this begs the question, is that, that inner ring, Jay, that you said, those downtowns, those CBDs, are they gone, for good? Is everyone always going to stay in the suburbs for forever? Or again, is this a flash in the pan? Because, we had a lot of migration to cities, to downtowns, and the pandemic really flipped that on its head. And in this article, and to Peter Linneman, he's a professor at the Wharton School, University of Pennsylvania. we've been talking about this a lot, but the reasons that you would live in a downtown is, it's close to your job. There's the food, culture, art, entertainment, sports, all the fun stuff. But that all went away, and so those are all the positive things. But the negative things, are the congestion, the traffic, maybe smog in some places. So you've got those are well, maybe the traffic, maybe not as much, but you still have some of the negatives, but like all the positives have gone away. So there's just not the draw. The question is, as we open up, are we going to see that kind of return? I think it's going to be slow. I think it's going to be there. It's going to be slow though. What do you guys think?
I think a lot is, and this is a question that I've posed before here, is which cities are we talking about? Is this going to be are all cities going to come back equally? Because I think that depending on which city you're going to live in, the fears of the pandemic are way different. I was just talking to investment associate William just yesterday about how, in New York, there's a completely different attitude towards the pandemic and towards the kind of it's a lot more fraught, and rightly so. It hit it hard, but I think that that's going to impact whether they want to go in the city or not with around more people. I think that so my guess is, yeah, cities are coming back. There is no way that, having seen the growth of cities in the past 10 years, especially in Indianapolis, I think that that they're going to snap back really quickly. But I think it's going to be slower in those cities where the general attitude towards the pandemic is a lot more cautious.
Yeah, no, I think that's a good point. It's interesting kind of seeing the different perspectives, people in different locations. And I mean, New York, I used to live in New York, and it's like you put up with all the literal crap, because you're in this place with all this stuff going on. That's the social theater, and people on the street, having fun. You go to all the restaurants and art, all that stuff we mentioned, but that stopped. Then you're still just dealing with crap. Literally. And so it begs the question, but like in New York City, not necessarily the same as a downtown Indianapolis or in Austin, or like a Miami or an Austin or a Dallas or a Phoenix, or even Indianapolis or Boise, Idaho. Totally different story than a New York City or Los Angeles or San Francisco. So I think it's good not to paint with a broad brush, but there's this big stigma about downtowns in general. I mean, I was just hearing it from some family member. Oh, well, Jay, we were out at lunch with some people yesterday who were like, hadn't been downtown forever. And they were like, oh, this place, it's like they're going into a war zone, or like going to like a third world country, or like the jungle or something. Like they're like ready to go. And like people are like, isn't there all this like racial stuff going on in the downtown? And I'm like, that was like 1 week. That was like in Indiana, that was like a weekend a year ago. And they're like, there's still like riots going on. I'm like, no, our office, we're here every day. But I get it. It doesn't matter. It's, perception is reality. So like, that's the perception. We're not going to go downtown. So, all right. So last thing to mention, I think we did a great job going over kind of what was in the Gray Report newsletter. But first, we have to, again, do a quick plug for grayreport.com. If you found this information remotely interesting, or very interesting, as I assume is the case, if you can't wait another week, we've got you covered. We knew you couldn't wait another week. That's why we developed the Gray Report, grayreport.com, the premier multifamily intelligence aggregator. It's delivering all the latest content. Again, articles. We got videos, we got podcasts, we got market stats. So just, you can pop on over to grayreport.com. Bam, this Biden administration tax proposal. We talked about it. Go read the whole thing right now if you missed the actual newsletter. We keep you up to date. What's going on in the markets. What's this S&P 500 doing? Commodities, click on over. You want to know where lumber is? Bam, we got the lumber price, right there. What about REITs? What's going on with these publicly traded, real estate investment trusts? The Res Index, all the residential REITs. We got Avalon Bay. We got Mid America. That's more, kind of Midwestern, Southeast, middle market markets. Check it out. What's going on? Again, these public markets, they can be a predictor, an indicator of the future. So it's important. Of course, we have cryptocurrencies, all the other stuff, macroeconomic news, other real estate news, podcasts, all in one convenient place. Hop on over to grayreport.com. And if you're not receiving the newsletter, pop on over to graycapitalllc.com/newsletter, or you can go over to grayreport.com and hit this button at the bottom, sign up to receive the Gray Report newsletter so you can have the information before, you watch this video, stay up to date. And again, if you really didn't look at any other information, you're busy doing what you do, working hard, you can stay up to date with just the one newsletter. And then you miss something in between, hop on over to grayreport.com. Matt, Jay, it's been a pleasure having you guys on. Love discussing what's going on in multifamily, the economy, all kind, any other tangent we go on. It's been great. Matt, again, he's the director of communications and marketing here at Gray Capital. Jay Reeder, he is our director of acquisitions and asset management. Both busy guys, a lot of stuff on their plate. So again, I appreciate your time coming on and talking some shop.
Thank you, as always.
Okay, guys, if you give this video a like, subscribe to the channel to stay up to date, get these videos sent to you, little bell icon, smash that button real quick, and we'll catch you on the next video.